Hello, everyone, and thank you for joining us today for another webinar here on our educational series. Today, we will be covering some tips to maximize your retirement plan contributions, as we do obviously know that the filing deadline for timely filers is coming up here in the next few weeks. So always good to understand what we have going on and being able to maximize some of those deductible contributions or just contributions to retirement plans in general. Please note that all audio has been muted on the listener side, so you will need to make sure that if you have any questions, do type those into the chat box. This won't be a too terribly long webinar today. It'll probably be about half an hour, so we'll try to get this short and sweet, get you the information you need, and let you get back on with your day. To get started, my name is Alex Perny. I've been with Advanta IRA since 2012. My colleague Larissa and I started around the same time. I'll let Larissa introduce herself real quick. Thanks for being on with us today, Larissa.
Thank you, Alex. Hello, everybody. Like Alex said, I've been around, we've been around about 10 years, a little over, and we have both worked in almost every aspect of the business. And so we both kind of started in accounting and handling different things. Alex, of course, did a lot in transactions, and I did a lot in the accounting department. And then over time, we have both moved over to business development, where we have been teaching classes and attending networking events. And I know I can say for myself that I really enjoy getting out there and learning what it is that you guys are investing in, and then in turn helping you understand how a self-directed IRA works.
Yeah, absolutely. Thanks, Larissa. It's really been kind of a fun journey to see that, and hopefully we'll get you all some good information here today as well. A little disclaimer before we really dig into this. Again, please do make sure that, especially when it comes to opening up a retirement plan or doing anything that affects your taxes, that you check with a CPA or an attorney, as Advanta IRA and our employees do not provide investment or tax advice, nor do we endorse any products. All information and materials are for educational purposes only, and all parties are encouraged to consult with their attorneys, accountants, CPAs, financial advisors before entering into any type of investment or account structure. With that said, what is a self-directed IRA? Here at Advanta, we talk about all these account types. All of them are self-directed in nature. We're not a broker dealer. We simply handle the alternative assets through self-directed IRAs, and more to the point, self-directed retirement plans. So if we're talking about something that doesn't have the acronym of IRA attached to it, which we will today, we'll talk about things like HSAs, Roth IRAs, SEP IRAs, solo 401ks, things that might be a little bit more of a blend of other types of accounts. Just to understand that the self-direction aspect of it, of everything that we do here, is uniform across any type of an account that we administer. So with the self-directed retirement plans that we do offer, these types of asset options that you have with these things include things like real estate. You can lend people mortgages and notes. You can do things like private placement, so investing into companies that have yet to go public and are in a pre-IPO phase. A very popular option right now, especially with the rising inflationary measures in the market, are precious metals. So you can buy things like actual physical precious metals and other items like that for your IRA. You can also invest in foreign exchanged currencies, futures, and a whole lot more. Another thing that we should probably put on there is cryptocurrency as well. So if you're looking to invest in really anything that's not a tradable security, so something not listed on the New York Stock Exchange or the Dow Jones average, you can invest with that utilizing a self-directed IRA. Now, some reasons that people choose to self-direct. Again, this can be a new source of capital for you if you are looking to raise money for a project that you might have. So if you're looking to raise money for a project, especially people like syndicators and general partners for different types of investment providers, and you're looking to help guide people maybe to utilizing retirement plans to not have to pay any taxes on their returns, now's a good time, especially for those investors that would be using business retirement plans like a solo 401k or a SEP IRA, to look into those plans to make those contributions, because as we'll get into, you can make up to the low to mid $60,000 range of maximum contributions into these types of plans. So if you're looking to raise capital, some of these kind of plans have significantly higher contribution limits than the $6,000 or $7,000 of a normal IRA. So something good to look at, especially when choosing or looking to get more education on why choosing to self-direct. If you're tired of the stock market, self-direction is a great way to help you truly get diversity out of the stocks, bonds, and mutual funds arena, because even if you try to diversify across different market segments, you're still investing in the same classification of asset for the most part. And what we're really going to focus on are the tax benefits of being able to make contributions to these plans, create larger tax deductions for yourself, and then also being able to reap the rewards of utilizing these types of retirement plans to return yourself tax-free or tax-deferred gains as well. If you want to learn a little bit more, we have a great platform for education. It's something that we're very, very happy with and we're very proud of. All of our education is free, so we hold pretty much bi-weekly events. So there'll either be 2 webinars per week, or will be a webinar and our Pitch, Promote, and Prosper event, which is an open networking call for investors to pitch or try to find different investments that we like to put on. That's every other Friday. We also, again, have our webinars, which you're attending today. A third avenue that we do have is our podcast, the Alternative Investing Advantage podcast, which now we're going up into about our 28th episode. So things are great with that. If you want to get a slightly different take on investors and what is actually going on in the marketplace, a great option for you as well. And we do catalog all of our webinars on our YouTube channel and can also be accessed through our video library on our website. And if you're someone that likes to consume your content via blog, we also do maintain an up-to-date blog with industry and tax news on it as well, which can be found at our website, advantaira.com. And if you're interested in getting started, again, this is a very simple process. Won't spend too long on it, but it's pretty much 3 easy steps. Opening up your account, funding your account. Specific to today, we're going to focus on what exactly that means for you with regard to choosing the type of an account, what that means as far as how much you can contribute, and what would or would not be deductible for you as the particular taxpayer. And then after that, after you get the account funded and opened, or open and funded, then you can start investing. With that said, I'll turn it over to Larissa, and she'll kind of begin with what we have for you on the front end with regard to IRAs and your contributions.
Thank you, Alex. And I also do want to mention again that if you do have questions, we are taking questions. We just won't unmute you. So keep that in mind. You can type your question into the question box, and as we go, we will answer questions for you. I also want to just make a quick comment on, the steps to get started, because many times people come to us with step 3 in hand and they need to hurry up and do step 1 and 2, and that's fine too. But if you are actively looking investments for your self-directed account, now is the time to get your account open, because there is a process involved, and it does take at least a few days and sometimes longer depending on where you're moving money over from. So please keep that in mind. So we're going to talk today about the plans and the contribution limits for those plans, and how those contribution limits and deadlines are coming up for you at this time. We're at a unique time of year right now where you can make contributions for both 2021 and 2022 in most cases. So most of these accounts you can establish now and contribute for last year, and you can do that all the way up until April 18th this year. We always, of course, recommend doing it as soon as you are able to, because, when you send us a contribution, if you put a check in the mail, for example, checks do get lost in the mail. The mail is slow right now. So if you're looking to contribute for 2021, let's get it going now so that we're not right up against that deadline in the event something should happen. But if you're looking to open and fund a traditional or a Roth IRA, you can certainly do that for 2021. They did not change the contribution amount for either of these accounts this year. So for 2021, it was $6,000. It will continue to be that for 2022. You still do have a $1,000 catch up if you are over the age of 50. So for those people over the age of 50, you can put $7,000 into either of these accounts. Keep in mind that if you have both a traditional and a Roth IRA, this limit is the combined total for these accounts, meaning that you can't contribute $6,000 for a traditional and $6,000 for a Roth, but you can do any amount to either of those, totaling that $6,000 limit. So if you wanted to make a traditional contribution and a Roth contribution, you could, for example, do $3,000 in each of those. So it isn't per account, it is total per individual. So keep that in mind. It also does not work if you have a traditional IRA with a brokerage firm and then say a traditional self-directed IRA. You can't make that contribution in total to both of those accounts, it would be a total combined of that 6,000. Again, it's per individual, not per account. The next account that we talk about pretty often is a SEP IRA, and a SEP IRA is a simplified employee pension. The purpose of this IRA is to help those individuals that are sole proprietors and independent business owners, and of course small companies or small businesses, save for retirement. It is a great account. We'll talk about it in a few minutes, and you can see that the contribution limit for a SEP IRA is $58,000 to a max of 25%. And so basically what that means is that you have a formula for making your contribution, but even if you've made well over a certain amount, the most you can put in is 25% or 58,000. So it's the lesser of the two. So if you had enough income, let's say you had $100,000 in earnings this year, then if you could contribute the full 25%, then that would put you at a maximum of 25,000. The great thing about a SEP IRA is you can still also have a traditional or a Roth IRA, because the SEP is an employer's plan and the traditional or Roth IRA are individual accounts. And so you can still have a SEP and a traditional or Roth IRA and make those contributions. For 2022, it's going to be, it did move up, so it's 61,000, and again, a maximum of 25%. With the simple IRA, you can contribute $13,500 for 2021, and that is an employee contribution. So now we're getting into accounts that have both an employer and an employee contribution. So with a simple IRA, the $13,500 for 2021 is an employee contribution. The employer does get up to a 3% match, and there's some stipulations and things, some elections that you'll make in the simple IRA that will allow you to contribute as the employer a certain amount. So it's between 1 and 3%, and whichever you choose, it does come sort of with a set of rules, if you will. So that's something to look at. It got bumped up for 2022 to 14,000, and you do have a catch-up contribution of 3,000 for the simple IRA for those individuals over the age of 50. We also have up here 401k, and these contributions are the same whether it's a solo 401k or you're a part of a larger employer's plan. And you can see here that the contribution limits did go up a little bit. And again, just like the simple plan, this plan does have both employer and employee contributions. It's $19,500 as the employee for 2021 with a $6,500 catch up for those over the age of 50. And then you do get another 20 to 25% contribution as the employer. And it's really not necessarily an employer match. It's simply an employer contribution, but we call it a match because that is typically how you hear it referred to. And then just the amount you can contribute, the combined total of those contributions cannot exceed the amount here. So 58,000 for 2021, and of course 61,000 for 2022, and then those limits go up a little bit if you are, I think we skipped ahead a little bit, if you are over the age of 50. ESA or Coverdell accounts or education savings accounts, as they're referred to, those contributions have not changed in so many years. It's $2,000 per year per child. And then, of course, the health savings account, which is another very popular account. It has either an individual or a family contribution. That's going to depend on the type of insurance that you hold. It's $3,600 for 2021 and then $3,650 for 2022, and there is a catch-up limit listed there as well. So that kind of goes over the plan contributions for you. If you guys would like a copy of the slides, please feel free to reach out to either myself or Alex, and we can help you with those. So any of these accounts can be self-directed. I know a lot of times people think for whatever reason that only a Roth IRA can be self-directed. I'm not really sure where that comes from, but that's something that I hear a lot. Well, I don't have a Roth IRA, so I don't want to self-direct it because then I would have to pay the taxes in order to have a Roth, and that's just not something I want to do. But the truth of it is any of these plans can be self-directed, and that includes the health savings account and the education savings account, because the rules for self-directing those are exactly the same as any of the IRAs or solo 401ks, and so those can be self-directed. Sorry about that, guys. Okay, so now we're going to talk a little bit about the individual plans, and then I'm going to hand it over to Alex to talk about the employer's plans. But a traditional IRA is a great account because anybody can make contributions to a traditional IRA that has earned income. And you can contribute again up to $6,000 or $7,000 if you're over the age of 50, as long as you had it in earned income. So sometimes people will say, well, I only had $4,000 in earned income this year. Well, then $4,000 is going to be the limit of your contribution for the year. The traditional IRA is a great account because it is usually a tax deduction, lowering your current tax burden for the year. It is tax deferred growth, and so every year that you have growth in that account, you're not paying taxes on it until the time that you distribute funds. And the great news about a traditional IRA is that you're only paying taxes on the amount you distribute the year that you distribute it. So you might have $1 million in your traditional IRA, but if you reach age 65 and you only distribute $10,000 that year, then you're only going to have a 1099 for that $10,000 that you distributed the year that you took it out. Any former employer plan can be rolled directly into the traditional IRA, and it is seamless, meaning that you're not going to pay taxes for doing so. So you're going to take any pre-tax account like a 401k, a 403b, a 457 plan, any of those that are considered pre-tax can go right into a traditional IRA, and there's no tax implications there. There is a deductibility phase out that we have noted here on the slide. So just be aware that it's possible that you'll lose the ability to get a deduction for making that contribution. And that is dependent on your participation in an employer's plan and your earnings, so your modified adjusted gross income. The next one that I wanted to talk about is a Roth IRA. And of course, a lot of people do like the Roth IRA because it grows tax-free. You can have earned income and make contributions to this account. However, there is a modified adjusted gross income level, at which point that does phase you out from eligibility to contribute. So be aware of that. But you still can contribute to a traditional IRA and at any time pay the taxes, do what they call a Roth conversion, and get that money into the Roth. And again, the benefit here is going to be tax-free growth and tax-free earnings, as long as two things are true. One, the account has aged for 5 years prior to distribution, and you are age 59 and a half or over. So as long as those two rules are true, then this account is going to be tax-free. So if you start a Roth IRA at age 50, you're making contributions and it's also earning. When you reach 59 and a half, the entire account can be distributed and it would be considered tax-free as long as those two things are true. There's no mandatory withdrawals. So when we look at a traditional IRA, at some point, the IRS does require you to take those funds out of the account, and that's at age 72. With a Roth IRA, there's no required minimum distributions, as we call it, or a mandatory withdrawal. And so as long as you have earned income, you can make contributions, and you also do not have to take that money out. And you do kind of want to look at it and say, okay, well, what's my tax situation now versus what it will be at retirement? And then you can talk to your CPA about whether a traditional or a Roth IRA makes the most sense for you. I know a lot of times people will say, well, the Roth IRA is going to be tax-free, so that's definitely the way to go. But you do want to look at it and say, okay, well, I don't get a deduction for making that contribution, and I need the deduction this year. In the years that I want to contribute, I'll likely need a deduction. And so then maybe the traditional IRA makes more sense for you. Or how close are you to retirement? There's a lot of factors that are going to go into choosing the account. And so we have a lot of information on these accounts for you here and on our website. And then you can always discuss that with your CPA. So again, the contributions are $6,000. Once you reach age 50, it's $7,000 because of the catch-up limit. And I'm sorry, that's a typo. It's not 50 and a half, it's just 50. So once you reach age 50, you can make those contributions and include the $1,000 catch-up limit. Contributions are based on earned income. So that's very important because if you have passive investments and so passive income, that is not going to be considered earned, and that's not going to help you contribute to your Roth or traditional IRA. So keep that in mind. So if you have mostly passive income, you are only going to be able to contribute up to the amount in earned income you had for that year, not to exceed $6,000. So that's very important. I know a lot of times people say, well, what constitutes earned income? You can go to the IRS website and check that out, or talk to Alex or myself after the webinar, and we can kind of go over that with you. Spouses can use joint income for contributions, and I think that's important because if you have one spouse that works full-time and one spouse that stays home, that the spouse that stays home is still eligible to contribute to a retirement account, which is great. You can use that joint income for those contribution limits, and the spouse that does not work can contribute the full amount as long as there was enough earned income in the household to make those contributions. We also have, the added benefit of combining traditional IRAs with other pre-tax accounts, and I think that's always important too. So if you have, a pension and a 401k and a 457 and a SEP IRA somewhere, and you are no longer participating as an employer or self-employed individual or with that business that sponsored those plans, those can all go into a traditional IRA. And at the end of the day, if you wanted to pay the taxes and convert them to Roth, you certainly can do that as well. Just keep in mind that the Roth conversion is a tax burden to you, not to the IRA. So when you do the conversion, it's not, oh, well, the IRA, you can just take the money out of the IRA to pay the taxes. It's 1099 as ordinary income to you the year you do the conversion. And then the converted amount does also have to age for 5 years independently of your Roth IRA. You still have time, like I said, to make your contributions, open, establish an account, and make your contributions for 2021. And the great thing is, even after age 72, you can still contribute to these IRAs as long as you have earned income. And the biggest thing with the traditional IRA is that you might have to take some required, or you will have to take some required amount after age 72, but you can also still contribute as long as you have earned income.
All right, thanks, Larissa, for covering that great portion of everything. And again, just remember, like she said, that if you're looking to make a contribution to a traditional or Roth IRA, you can still open and fund one if you don't have one for last year to either get a tax deduction or not with the Roth by the filing date plus extension. So if you write a check and you date an application and you get it postmarked by the filing date, you can still open that account. So just keep in mind that you do have some time left. We're happy to help you. Just circle back with us afterwards so we can get it taken care of for you. Now, there's a little bit of a different date window for some of these things that we're going to be covering here with the employer-based plans. Because when you look at filing deadlines, the business filing deadline is not the same as the timely individual filing deadline for people. So businesses don't file on April 15th or the next applicable business day. They will file typically in October, or if there's an extended filing deadline, it can be a little bit different for people as well. So when we're talking about some of the deadlines for employer-based plans, they're going to be slightly different than what you're going to be looking at with your filing deadline coming up next week. But also keep in mind that if you are a self-employed individual, or let's say an S Corp or a single member LLC, and you're going to file all your taxes on the 15th, then if you want to make a retirement plan contribution, especially with an employer-based plan, then you're going to have to take that into consideration as well to make some of these contributions. We had a question come in: the advantage of using an IRA for HSA. I'm not exactly sure what you're asking, Karen, but if you could please elaborate on that a little bit, we're happy to get that taken care of for you. Larissa will certainly be happy to address that in the background. So SEP IRA, Simple IRA, and 401k. What kind of people are these plans for? Well, anyone that's self-employed, or really anyone that runs a small business. However, once you start extrapolating these things into having what are called common law employees, and we'll get into what exactly that is in a second, they can get a little bit more complicated and a little bit more expensive to administer. So for the purpose of what we're talking about here, it is the self-employed individual, the husband, and or I should say the spousal working unit, if you will. So a spousal couple or a household that owns a business together with no non owner operators operating the business. So just think about it like that is what we're going to be referring to here. So benefits from these types of an account. SEP and simple IRAs offer tax deferred growth. So there's no inherent after-tax contribution to either of these types of plans. But what the benefit of that is that if you had, let's say, a high wage earning year in the previous year and you didn't have a lot of other write-offs or losses that can help to augment or offset income that would otherwise be taxable to you, a SEP and a simple IRA are fantastic tools for that. And as Larissa kind of reviewed with the contribution limits, the simple IRA definitely is the smaller of the two, but it definitely has its place, especially if maybe you have more seasonal employees. If you, let's say, own, like I have a client with a surf shop here down in Southwest Florida, and he'll have a few high schoolers come and work over the summer months, but no one that qualifies as a common law employee, so he can be excluded from the plan while still also having the good benefits and tax deduction of him working there year round. To be able to benefit from that plan. So simple IRAs definitely on the shorter end of that. SEP IRAs have a significantly higher contribution limit, being 25% of your income for that year, plus your traditional IRA contribution going in there for making deductible basis contributions to that plan. Now, both of these, or I should say the SEP IRA, you have until your filing deadline plus extensions to contribute to that plan. But if you are, let's say, just a self-employed individual, and I'm thinking a lot of people here, maybe you're a realtor or a independent contractor salesman, or let's say a contractor that runs a construction business, and you want to file on the 15th, you have to establish and contribute for last year by your filing deadline. So if you file an extension for your business, or you're going to file at a later date, SEP IRAs can be established and funded at a later date, such as your extended filing deadline. Simple IRAs, though, are a little bit different insofar as that you had to have them established before September of the previous year, or by September 15th of the previous year, in order to make a contribution for the previous year into the next year up until the filing deadline plus extension. So they're a little bit more complex. Again, not nearly as popular as the SEP IRA, because the SEP IRA is the Simplified Employer Pension, and it definitely worked off the backbone of the simple IRA to offer a simpler way to contribute. Now, larger contribution and lower administrative costs than a 401k plan are definitely two big advantages for the SEP and simple IRA. Again, they are significantly easier to administer. There's less administrative overhead, and it is much more streamlined when it comes to calculating contributions, where, with the SEP IRA, you just multiply your income by 0.25 and it spits out a number. And if it's less than your total allowable, you can make up to that. Or if it exceeds your total allowable contribution, as Larissa had referred to in the previous slides, then you can make up to that allowable contribution limit. So easy stuff to kind of wrap your head around when it comes to factoring contribution limits. Now, the individual 401k does offer the largest potential contribution for a business without employees. Again, with employees, you have to do things called discrimination testing, and there's safe harbor rules and top-heavy plan testing. Now, I don't expect anyone to really kind of understand what I just said. Just suffice it to say that they're a lot more complicated than these other types of plans. So while it does add a degree of complexity, you do get a higher degree of contribution limit and flexibility with how you're making contributions to that plan. And 401ks also do have an option to be able to make contributions after tax. So like Larissa was going over the difference between traditional and Roth, one being deductible, so you get a write-off for adding money in there. The Roth being after tax and getting no write-off, but growing everything completely tax-free. The same kind of allowance holds true with a 401k, is that you can make part of your contributions pre-tax or post-tax, or a combination of both, and you can really kind of fine-tune your taxable deductions and how you're going to be taxed in the future with a solo 401k plan. A really cool functionality of those plans specifically that you do not have really with any other plan. So you don't have this kind of duality with a traditional or Roth, SEP, or simple IRA. You get that kind of, that a la carte tax deduction or non-tax deductible after-tax contribution with a solo 401k. So again, they are more complicated, can be a little bit more expensive, but you do get a much greater degree of flexibility when utilizing that type of plan. So SEP IRA, simple IRA, and 401k. What types of employees are excludable? Now, I don't want people to get the wrong impression and think that we're just here to be, Scrooges and tell people how to, make sure that you're not covering employees from a retirement plan. It's good information to know, because especially if you're a self-employed individual and let's say you contract out some work or you have a bookkeeper, the last people you want to run afoul of are people like the Department of Labor and the Internal Revenue Service if you didn't properly, according to their rules, offer a business retirement plan to an eligible employee. So it's important to understand when you need to engage someone that can properly help you do things like plan disclosures and plan testing, or when you don't need to worry about it and those people can be excluded from the plan in general. So it's just good to know. Again, we're just doing this so that way people can make a good educated decision on which plan they'd like to go with. So what types of employees are excludable? So you can exclude anyone that is under the age of 21 from a retirement plan in general, non-resident aliens or unionized employees. So if you have an employee that is covered under a collective bargaining agreement, then they can be excluded from things like SEP IRAs, simple IRAs, and solo 401ks. The reason being is most of the time is that their unionized employee, that their union that they are a part of that is collectively bargained some type of labor agreement typically will include some type of retirement plan or pension within that. So that's why you're allowed to exclude them. Non-resident aliens, again, depending on their employment, their immigration status, you need to make sure that you are only excluding a non-resident alien instead of a resident alien. So you just need to make sure that you are fully aware of a what am I thinking of the status of their actual uh, their immigration status if you are dealing with people in that scenario, and obviously anyone under 21. Now, what types of employees must be included or must be offered these types of plans? Keep in mind that these rules did change back in the end of 2018 with the passing of the Secure Act, which was the large chunk of tax reform legislation passed under the Trump administration. So it used to be that you only had to include employees that worked over 1,000 hours a year for you with a solo 401k. It was easy, just they worked over 1,000 hours a year, you had to include them. Now, you have to do a little bit more digging. So the rule of 1,000 hours per year still holds true. Or if they have worked 500 or more hours for 3 consecutive years, or over 500 or more hours for 3 consecutive years, or 500 or more hours over a 5-year testing period. So you have to make sure that if they are a long time, more seasonal employee and they have worked 5 years and over 500 hours in 3 of those 5 years, you do have to include them as well. So just need to be aware of the updates. So if you have someone that works over 500 hours a year for 3 consecutive years, they do have to be included in that solo 401k plan as a normal employee. SEP IRAs, you have to include anyone that has worked at least 3 of the last 5 years. And a simple IRA are those that have received at least $5,000 in compensation within during any of the last 2 during or within the last 2 years. Sorry, a little bit typo there. So these are important things to understand of people that can automatically be excluded from a business retirement plan, and then those that you do absolutely have to offer the plan to. Now, what you really want to kind of keep in mind is that, when we say you have to offer it to them, some of these plans have what are called non-elective deferral contribution, meaning that if you make the employer contribution into any one of these types of plans, you have to do it for everyone. So like, let's say a solo 401k, you can contribute, or a 401k plan in general, you can contribute up to 25% of the net operating income of the business to the plan. Now, if you, let's say, were the only employee, you owner operator for many years, and then you just hired someone and you had $100,000 of net operating income and you contributed, the maximum, which would be 25 grand to your 401k. If you wanted to do that in the same year that you had the new employee, granted, they could say, hey, I don't want to contribute any of my paycheck. So my elected deferral, I don't want to have you take anything out of my paycheck. But if they have to be offered the plan and you do the non-elective deferral, so that 25% of the NOI, and let's say you had another $100,000 a year, you couldn't contribute the full $25,000 to your plan. You'd have to split that $25,000 contribution between you and the eligible employee, even if they didn't want to contribute out of their own paycheck. That's why it's called non-elective deferral contribution. So you need to be careful when you look at this, is that, just because you have an employee that says they don't want to participate, you still might be on the hook for a large contribution if you don't make an augmentation or change the plan when you know that you're coming up on having employees. And again, this is not to say that you should be trying your hardest to exclude people from these plans, but you need to also weigh the cost and benefit and how much something is going to inherently cost you versus the perceived benefit in that plan to let's say, a rank and file employee. Again, most of this not necessarily applicable to people that we deal with, because we deal strictly in our plan document providing with just the self-employed individual or the owner-operated business owner. So this doesn't typically crop up, but if you are someone that's looking to grow your business and you're starting out from the ground floor with just you, or you and a spousal partner, then you need to understand how these things scale and what that's going to mean for you in the future.
Also,
So
Alex, we did have a question pop up that I think is important to the audience. They were asking if they have a W-2 job and then also some 1099 income, would they be eligible for an employer-based plan? And the answer is yes. So I am a W-2 employee of Advanta IRA. And if I had a side hustle or my own business as well, as long as I had self-employment income, so remember, it can't be passive income, but self-employment income where you're paying the Social Security tax, then yes, you could be eligible for a SEP IRA or a solo 401k and make contributions to that plan. The contributions would be based on those self-employment earnings. So keep that in mind, and it will depend on how you are paid. So just something to note, because I thought that was a great question to the audience, because as Alex mentioned, a lot of times we're not dealing with people that do have employees, but instead sole proprietors and independent business owners with maybe just themselves and their spouse as employees. Thanks, Alex.
yeah, great point, Larissa. And to further piggyback on that, I think something other to be aware of is that, let's say in that same scenario that Larissa posed, you have she's obviously a W-2 for Advanta, but she has, her side hustle selling widgets on eBay. Now, from that side business, if she is contributing to her retirement plan here, she can only make the elective deferral contribution of, let's say, a 401k. She would be eligible to contribute up to $19,500 of her compensation to a plan. Now, that would be limited across all plans. So if she maxed out her elective deferral here at Advanta, she couldn't also defer that portion of her income from the side hustle, but she could contribute the non-elective deferral portion. So that portion of the net operating income that she is receiving, her total compensation of the side hustle, she could potentially contribute 25% of that under the non-elective deferral portion of that plan. So there's a lot of different nuance when it comes to being covered under multiple retirement plans, much longer than what we have here specifically to cover. But just be, the short and skinny of what she was saying to answer the individual's question is, yes, you can be covered under multiple retirement plans and contribute to all of them, but you're going to have a little bit more back-end calculations to do on making sure that you are not over contributing to any one of these types of plans and maximizing your allowable contributions as well. So SEP IRAs, the Simplified Employer Pension IRA, the significantly simpler version of the Simple IRA, which the Simple IRA, I think, is a horrible acronym for a very complicated plan to contribute.
I agree.
So contributions to a SEP IRA are pretty easy. Again, this is simplified. It is going to be 25% of your compensation, which you are limited to $58,000. And again, remember, this is not including the $6,000 or $7,000 traditional IRA contribution that you can also make to one of these types of plans. So keep in mind the 58 and the 61 that I'm referring to here are just based on the compensation deferral, the non-elective compensation deferral that you're making in a SEP. So for 2021, you can contribute up to 58 grand into a SEP IRA. And for 2022, you contribute up to 61. The contribution can only be based on the first 270 of compensation for 2021, and it's escaping me. The new one is like 310 first compensation, first in first out compensation calculation for the SEP IRA in 2022. But the important thing to understand is that those are the two big numbers you need to look at, or three, I should say. 25% of compensation, and that can equate to either 58 grand of total contributions for 2021 or 61K for 2022. contributions for these are deductions for the business and reduce the amount of income that you're going to claim. Now, typically, if you're filing as a sub S or if you're filing as a sole proprietor, this is kind of a moot point on whether it's claimed as the business or the individual because it all passes through to you. Now, big asterisk disclaimer, always check with a CPA or tax advisor to make sure that you are attaching that tax deduction to the right place because everyone's different. Everyone's taxable situation is a nice, unique snowflake, and always check with your CPA to make sure that you're maximizing any type of contribution attachment that you're looking for. So self-employed individuals calculate your contribution less 1/2 of the self-employment tax. Remember, the IRS is going to get you one way or another, and you got to make sure that you're basing your calculations correctly. So you take your total revenues or your total income, and then you calculate the contribution less 1/2 of the net of the self-employment tax that you take out. Contributions do not have to be made each year. So you're not locked in, unlike with a simple IRA where you have a lock-in period of full 2 years before you can augment any plan elections. A SEP IRA and a solo 401k, you can change every year. So you don't have to do contributions every year, and you don't have to do the same amount of contribution each year. Contributions must be made by the filing date plus extension. So with a SEP IRA, if you're going to file everything for yourself as a self-employed individual next week, or sorry, on the timely filing deadline this year in April, you got to get that done, now or pretty soon. But if you're going to file an extension, then have at it. The traditional and the Roth are really the only two things that have a hard deadline of account opening and funding for last year by the filing deadline. SEP IRAs, simple IRAs to an extent, and solo 401ks all have a good amount of runway with regard to when you can establish and fund those plans. But keep in mind, if you are going to file your taxes early or timely, then all of your plan establishment and contributions have to be done by when you file the taxes for that activity. So if you filed your taxes, you can't in September say, oh, well, the business deadline's now, and I filed back in April, I'm just going to go ahead and do this and refile my taxes. It doesn't work like that. You got to do it when you actually are going to file those taxes. Simple IRAs. So with regard to simple IRAs, again, they're not super straightforward. They are not very simple, but they do have their place in so far as that they allow for a lot more flexibility, especially people with more seasonal employees, if you do have employees, because the exclusions are a little bit easier to do with a simple IRA. But just it's good to know and good to have a good rounded perspective of what plans are out there for the self-employed individual. So the elective deferral limit, meaning what you can just defer out of your paycheck, electively out of your paycheck, is $13,500 for 2021 per year per employee. You have an additional $3,000 catch up if the employee is over 50. So potentially $16,500 or the like, or $13,500 depending on your age. Excuse me. Do you have something, Larissa?
No, go ahead.
Okay. Company contributions are either 2% non-elective, meaning that the company is just going to say across the board, all employees get 2% of their compensation contributed non-electively. So whether the employee wants to contribute the full $13,500 or contribute $1 to the simple, they get 2% across the board of that. Or you get 3% matching of each employee's compensation. So depending on what the compensation of that employee is, one may or may not be, a much better deal. If you have very highly compensated employees, then the first one might be a cheaper deal for you. If you have very low compensated employees, and not to say that you should be paying your employees very little, but again, you're not paying someone working at a surf shop $40 an hour to sit there and sell surfboard wax and sunglasses. So if you have lower compensated employees, then the 3% matching of the compensation would certainly be a cheaper option while still allowing for a retirement plan to be established and it being cost effective for everyone involved. Now, the plan must be established by year end of the previous year in order to make contributions in that year. You have until your filing deadline plus extensions, but simples have to be opened in the previous year, unlike every other type of plan. So simples are still the ones that are, have that little bit of more of an antiquated setup deadline of having to be done in the previous year. Now, some rules: employees cannot be covered by another simple plan. So they can't have another retirement plan covering them, especially a simple. You cannot roll over out of that plan for 2 years from the date of the initial contribution to the plan. You must include all employees who are making over 5K a year, and there's a lot of regulations on the coverage and contribution limits for these plans. So just keep that in mind. SEP and simple IRA advantages, they're less expensive to administer, and they're relatively simpler than other types of business retirement plans, such as 401ks. Contributions are made directly to IRAs for the individuals, not necessarily invested as a whole kind of omnibus investing structure that's done with a 401k, where it's more of a pooled asset structure. There's no fiduciary liability, so there's no trustee relationship between the plan administrator, which reduces your liability exposure to a point. So just keep that in mind if that's something you're concerned about. The individual employee can choose the IRA custodian, so you're not locked into using one versus the other. So if you have an employee that wants to administer it somewhere and you have it somewhere else, you can certainly do that. Flexible contribution and distribution features, and employer contributions only to those employees with more than 2 years of service for a simple or 3 years of service with a SEP, again, falling under those hourly guidelines as well. Solo 401ks. Again, these can be kind of complicated, and I don't expect everyone to necessarily get everything they need to out of the presentation today. I encourage you, if you have questions on solo 401ks or anything like this, reach out to Larissa or myself. We can get you squared away easy enough with this stuff. So just use this as a good baseline. So contributions, there's two different types of contributions that you make to a 401k. One is what's called your elective deferral, or basically what you're saying, hey, I'm going to take this out of my compensation that I'm paid and contribute it to a plan. So I can change this from paycheck to paycheck. An employee can change this from paycheck to paycheck. If you've ever worked in a corporate job and you've had a 401k, if you look at your pay stub, this is what they remove out of your total gross pay and contribute to the plan. This is your elective deferral. You've elected to make this contribution. So you can contribute up to $19,500 of your compensation of your elective deferral to the plan per year, and $25,500 if you're over the age of 50. So you get a $6,000 kicker if you're over the age of 50 for your contribution on the front end of a solo 401k. Now, the non-elective portion, so the portion that you make out of your profit sharing is what a lot of people like to call it, is up to 25% of the net business income, or $38,000. Now, if you're a self-employed individual and everything's passing directly to you, you're just going to use the total compensation number to calculate what that non-elective portion will be. Now, keep in mind, if you have employees, that $38,000 is per participant. So if you had, let's say, you only had $100,000 of NOI and 2 employees, then it'd be $25,000 of profit sharing contributions you could make, but each employee would only get $12,500 of non-elective contributions to the plan. I know that's a lot to kind of take in. The math's not too hard, but the concept is a little bit interesting. So if you have questions on it, let us know. The easy way to think about it is that if you have multiple employees, that profit sharing has to be split across all of the active participants or eligible participants of that plan. I wasn't joking when I said solo 401ks are a little bit more complicated than SEP and simple IRAs. Elective deferrals can be made as deductible or non-deductible. So that front end portion, that $19,500 or that $25,500 that you're making to the plan that you've just taken out of your compensation, you can either make that deductible or non-deductible. So it can be either Roth or traditional. So you got a lot of flexibility with that. One of my favorite parts about the solo 401k is that flexibility to allow you, the duality of pre-tax and post-tax contributions all under the same roof in a 401k. Now you can split this up. You can have a traditional 401k and a Roth 401k just for ease of accounting purposes. You can invest this again as an omnibus account and then just do net earnings attributable to the pre and post-tax tranches in that plan. Again, a lot of really kind of financially geared terms there. The easy way to think about it is that you can either have these segregated or commingled, doesn't matter, whichever way works best for you. You just got to have a CPA that knows what they're doing or a bookkeeper to kind of split it out in the end. So some rules: solo 401ks cannot cover businesses with rank and file employees. That's a solo 401k. 401ks can absolutely cover businesses with rank and file employees. You just need a plan administrator and plan document provider that can do the testing and everything else that goes along with that. Solo 401ks can only cover business owner, spouse, and equitable owners. So if you have an owner operated business, you have 15 owner operators, they all own some equity in the business, you could have a solo 401k that covers 15 people. But the second you have one rank and file employee in that 15 employee tranche, then you got to have a complying 401k. So just keep that in mind. If you have, a family-owned business where everyone that works there is, let's say, a mother, father, son, daughter, and a spouse, so you had 4 owner operators of a business, you can use a solo 401k for that, so long as that it's only owner operators running the business. And
Also,
yeah,
Alex, I just wanted to point out too that if you do have employees, you still are offering the 401k, but you would also like to self-direct. It is possible to self-direct those accounts with what we call a qualified plan record keeping account. And basically, we're just record keeping the portion of that plan that you would like to self-direct. So we could possibly help you with that depending on the current plan provider for your plan. So we could talk to them and see if we can work with them on what we call a record keeping account. Just keep in mind that if you would like to self-direct, you will have to allow your employees to self-direct as well. And really, for us, that's not complicated. We do have a lot of these specific types of accounts where you're just moving over a portion of the 401k, the portion that you want to self-direct, and your plan administrator is still going to do all the recording and reporting for that plan. We just hold that private investment on your behalf. So if it's something you want to do and you do have employees and you have a plan in place, it is possible to do it, and we can talk to your plan administrator and see if they will work with us on that type of plan.
yeah, absolutely. Good point to bring up, Larissa. And we're kind of bringing this in for a landing as well. So some advantages of the solo 401k, which I've kind of gone over in different portions of this, is that you have all the benefits of traditional business retirement plans, plus much higher funding limits. You can defer a larger portion of your earned income. You have funding flexibility, so whether it's pre-tax or post-tax, plus the non-elective deferral portion, so that profit sharing as well. A lot of different options. You can roll over other retirement plans into a 401k with one big caveat. I did mention that you can have a Roth 401k. They're great. You can roll a Roth 401k directly into a Roth IRA. But one really strange quirk of the Internal Revenue Code is you cannot fund a Roth 401k with a Roth IRA. So if you're looking at all this and saying, oh, great, I'm self-employed, I have this big Roth IRA, I want to use it for the seed for my Roth 401k, unfortunately, you can't do it. It can only go, Roth can only go out of a 401k. Roth monies can't go into one. Roth monies have to be strictly contributions or conversions of the in-plan assets. You do have access to tax-free loans, not something that we get into a whole lot, but you can do what's called a participant loan where you borrow money personally against a 401k. There's a lot of distribution options, relatively cost-effective administration, and again, Roth 401ks as well. And with that said, we certainly happy to take any questions. That's kind of what we got for you here today. Contact information is up there on the slide in front of you.
Yeah, we'll give you just a second if you wanted to type in any additional questions. And in the meantime, I want to let everybody know that if you are interested in learning more specifically about any of the employer's plans and also the solo 401k, we do have webinars recorded to our YouTube channel. So if you go to YouTube, search Advanta IRA, you will find Alex has done several webinars on employer's plans specifically. And then, of course, we have several just on the solo 401k because as Alex went into it, and as you can probably guess, there is a lot of information that goes into the solo 401k, and it is a great account. It is worth learning about if you're looking at some sort of plan as a self-employed individual, but there are some nuances that you should be aware of. And so if that's something you're interested in, you could go to our YouTube channel and check out the webinars on solo 401ks. I know myself, I have done several. I think Alex has done a few, and some of our partners have done them as well. So it would be something definitely worth a listen and watch if you are looking at that. We were asked about the slides. Yes, you can get the slide deck. Please send an email to either myself or Alex, and we will make sure to get them out to you. The YouTube channel we don't have really a name for it, but if you go to YouTube and search Advanta IRA, you will find us on there.
Yeah, if you want the URL, it's www.youtube.com/Advanta Largo. So it's not super intuitive, but that's what it is if anyone wants it. So youtube.com/Advanta LARGO.
And again, guys, if you want the slide deck, just go ahead and shoot us over a quick email. We'll send them out to you. And if you have any questions, let us know. I think that is it. So if we're, oh, and you know what, somebody did ask me about the 70.5 rule versus the 72 age for required minimum distribution. So I do want to just point that out, that it used to be your required minimum distribution started at age 70.5, and with the Secure Act that did change to age 72. So if you saw that in the presentations and you were wondering about that, the reason is because in 2020 with the Secure Act, they did raise the age of required minimum distributions. Those individuals that already started required minimum distributions at 70.5 did have to continue with them, but if you had not reached that age yet, then they did bump it to 72.
And keep in mind that there's a new chunk of legislation which they're kind of calling Secure 2.0 that does have the potential to raise the um, required minimum distribution age to 75. So that's on the radar, but it hasn't passed yet. It's still kind of in committee. So keep an eye on that. It might change again here in the next year.
All right, Alex, I think that is it. Again, guys, email us if you have questions or you'd like a copy of the slides. We appreciate everybody for joining us today. We hope that you will join us for the next presentation and also our networking events. You can find those on advantaira.com/events.
All righty. Thanks for being on, Larissa, everyone. Have a great day.